The big concern for many retirees is how to afford health care costs in retirement. Coming up on the Wheelhouse Retirement Show, we'll explore your options for health care coverage in retirement, and Rishi gives us a closer look at the basics of Medicare. Plus, IRMAA and Tax Planning is in this week's Planning Tip of the Week. And later, long-term care is one of the most pivotal parts of retirement planning, but Rishi and Anthony will tell you all you need to know. The Wheelhouse Retirement Show starts right now.
Retirement is more than a destination. It's a journey that starts with a dream. A vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now in its second season, the Wheelhouse Retirement Show provides you with the essential strategies needed to plan your ideal retirement. From income planning and wealth management, to strategies for taxes, long-term care, and leaving a legacy, Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group provide modern solutions and comprehensive plans for your journey to and through retirement. This is the Wheelhouse Retirement Show.
Welcome into the Wheelhouse Retirement Show. I'm Amy Sharp. Joining me today is Rishi Ghosh and Anthony Stryker with Wheelhouse Advisory Group. Great to be with both of you once again.
Excited to be back.
All right, here we go. Another great show for our viewers. Another concern for a lot of people is regarding their plans for health care, and that's a big topic that we need to just dive right into.
Yeah, you know, healthcare planning is a pivotal part of holistic retirement planning, and actually it ends up being mathematically one of the biggest reasons Anthony and I and our advising team tell people maybe they should rethink their retirement date or plan a little bit differently, because if done incorrectly, you know, healthcare can be a very large cost when it comes to somebody's retirement plan. When it comes to the stages of healthcare planning, we always tell clients to focus on the three different stages. There's typical health insurance. That's for our clients that retire prior to 65 years old and planning for that health insurance. There's Medicare supplements. That's post age 65. So once you get to 65 years old, you become eligible for Medicare. And then there's long-term care and major medical, which, as a lot of people know, either fortunately or unfortunately through families, it does tend to happen. That could be nursing home care, assisted care, hospice, or very major costs associated with those types of cares. And honestly, that can happen at any time, but realistically, we're talking probably late 70s, early 80s, hopefully never. But those are the three stages that we always help our clients focus on.
And there are a lot of options out there when it comes to healthcare that families can choose from.
You know, throughout my career, I started to look at some of these changes that I've seen from my early retirees and my early clients to some of my clients coming through the doors over the last few years. And I remember, you know, close to a decade ago when I started this process and building this philosophy of total retirement planning amongst the firm, is most people had a goal of 65 as their retirement date, or even sometimes 63 and a half, which puts them within 18 months of Medicare age. And they always thought that that was the thought process with retirement dates. I have to get to Medicare, or I got to get to full Social Security age in order to retire. But I tended to see over the last few years, as people get older, as people's assets start to grow, as retirement planning has evolved, more and more people want to retire much earlier than 65. I mean, we have people that retire 60s, mid-50s. We have some clients in their late 40s that have retired because they've saved so well through their accumulation phase of life. So starting with the healthcare options regarding people that retire before 65. The first option is to stay on COBRA. A lot of people know COBRA. You can get 18 up to sometimes 36 months of eligibility when it comes to COBRA. And then the other option really is the open market, or what we call the marketplace. Plans and costs are dependent on income, dependent on location, dependent on the type of plan you select. But generally speaking, for people prior to age 65, you're looking at those two options, COBRA and Marketplace. And there's some pros and cons associated with both, but that's what our main focus is.
Yeah, let's go a little deeper and talk about those pros and cons, what's out there that someone should really be considering.
So first we'll start with COBRA. Just like investment, just like any type of part of retirement planning or life, everything's got its pros and cons. So what COBRA is essentially you staying on your company's health plan. And what that can do from the proactive side of things is it makes sure there's not a sudden change of I retired, I'm before 65, and then I have to go on some other type of health plan. So it's something that you are definitely familiar with when it comes to your networks, when it comes to your providers, and exactly how things work and payment for for different services. And then there is, that's also going to keep the same coverage for your spouse and for your children and whoever you're covering in your family. So that's another pro for COBRA. And so it's really all the same processes. On the con side, it only covers 18 to 36 months there. So, and it depends on, very specific parts of your plan and your situation of how long that will cover you for. And then also, this plan, you're going to be paying for it out of pocket. So for most companies, your company is not going to be paying any part, or they maybe pay a minimum part of your premium here. So it's probably going to be a little bit more expensive than some of the other options out there. And then COBRA is only required for larger companies over 20 or 30 employees. So if you have a smaller company, COBRA might not even be an option for you. On the other side of things, the Affordable Care Act marketplace, that's something through what some people call Obamacare. And so because you are on a different plan where you're kind of picking and choosing exactly what you want depending on your situation, those costs could be a little bit less. You can stay on those plans for longer than longer than that period for COBRA. And then there's also flexibility to change plans so that, if you didn't like this one, I can go to this one, which you obviously don't have that type of flexibility with COBRA. But of course, the con is you're no longer on your work plan. And even though you're paying less potentially, you might, be in some processes and situations with hospitals, doctors, and how to pay for them that you might not be used to. So the costs can just vary year to year, depending on your health, your situation, your income. There's a lot to focus on when it comes to these two different options.
And I know we're tight on time for this segment, but finding the best option for me, how do I do that?
That's why we always tell people you need to start retirement planning at least 5 years prior to retirement, because as Anthony mentioned, there's pros and cons to COBRA, just like there's pros and cons to the affordable healthcare marketplace. And, prices vary. A lot of people, right when they retire or have a sudden change in their lifestyle, they enjoy staying on COBRA, even though it may cost in some situations a little bit more. It's a plan that they're used to. They know the doctors they can get to. They know what types of bills essentially are going to come to them after a doctor's visit or a dental visit. With the marketplace, sometimes it can be a little bit cheaper depending on situations, but sometimes you have to change providers. So it's all about planning. It's all about your individualized situation. But more importantly, it's about making sure it's the right plan for you, because it doesn't matter who you are. Health insurance is imperative in order to have a successful retirement.
Thank you so much. Important tips to keep in mind. And coming up next, Rishi and Anthony break down the basics on Medicare. Plus, Rishi gives us a look at IRMAA and tax planning in this week's planning tip of the week. And later, if you haven't thought about how you'll pay for your nursing home or long-term care needs, Rishi and Anthony share your options. The Wheelhouse Retirement Show continues next.
Have you thought about your plan for long-term care? Do you need a policy to pay for it, or can you self-insure? If you have questions about long-term care planning and all the options available to you, you're not alone. I'm Anthony Stryker, and our team at Wheelhouse Advisory Group can help you create a plan to meet your personal needs and protect your hard-earned assets. If you are confused or concerned about planning for long-term care, call us today to learn how to steer your future in the right direction.
Welcome back to the Wheelhouse Retirement Show. We're back with Rishi Ghosh and Anthony Stryker with Wheelhouse Advisory Group. And we just finished talking about healthcare coverage options for early retirees and those under 65. What changes in terms of the healthcare once someone turns 65?
So at 65 years old, you now become eligible for the country's federal insurance plan, which is known as Medicare. And there's a lot of different parts that go with Medicare. People hear about Plan A, Plan B, Plan C, supplements, Medicare Advantage. But let's start with just the basics, because there's a lot of misunderstandings when it comes to signing up for Medicare. So for example, if you're 3 months from age 65 or older and are not getting Social Security benefits, you do at 65 have to sign up for Medicare Part A and Part B. That does not happen automatically. So for our clients that decide they want to continue to work, whether they're doing full-time work, part-time work, or just fun jobs, past age 65, if they haven't started their Social Security benefits, you have to make sure you sign up at 65 or within 3 months of 65 for Medicare. But if you've already begun receiving Social Security benefits, you'll get Medicare Part A and B automatically when you become eligible at age 65. That does happen automatically. I know a lot of people come into our office and they may be working and getting close to 65 and they said, oh, my brother, my aunt said I have to go sign up. That's not always the case. It's just understanding what your situation is. Sometimes you have to, sometimes you don't have to.
Okay, let's break this down just a little bit further, going step by step through each part of Medicare. We're going to go A, B, D, whatever other alphabet letter you want to choose there, Anthony.
They go on
Yep.
for a while there, and the most basic parts are Part A and B, like Rishi mentioned there. So Part A is going to cover your hospital costs, and this is actually something that you do that was part of the original Medicare program, and this is actually free here. So Part B is going to be your outpatient visits to the hospital, and then also your doctor's visits. It's going to cover a portion of that. That was also part of the original Medicare package along with Part A, and this is where you pay a premium. You can either pay it from your Social Security. If you're not starting your Social Security, you can pay this directly to Medicare, and the premium that you pay for it for these outpatient and doctor visits is based on your income. That's called an IRMAA charge, and we'll talk a little bit more about that during our tip of the week in a little bit here. And then one optional part is if you're taking a lot of specific prescription drugs, Part D, it's really one of the only things that makes intuitive sense is Part D for drugs. That's something that there's several different Part D plans that you can get on to match up for your plan, for your overall drug plan.
So it seems like those might be a little bit more straightforward. Where the confusion starts to come in, it seems, is when we're talking about Medicare Advantage and Medigap.
Yeah, so what a lot of people get confused about because they get a lot of paperwork in the mail or emails, or they get bombarded with phone calls, is regarding Medigap and Medicare Advantage. So just very simply, people get Medigap and Medicare Advantage to fill in the blanks or fill in the holes that Part A, Part B, Part D do not cover when it comes to Medicare. So very simply, Medigap is like a plan such as a Plan F. Medicare Part C is where you hear more of the commonly known phrase of Medicare Advantage. So there's pros and cons. So if I start with Medigap, for example, Medigap covers doctors and hospitals visits that accept Medicare. The bigger advantage is also you don't need a referral from a primary care physician to see a specialist. So you can essentially go to pretty much any doctor that you'd like to. The downside of Medigap, or one of the downsides, is generally more expensive. There's pros and cons to Medicare Advantage as well.
So Medicare Advantage, these are independent private insurance plans that are covered by Medicare or that are done through the Medicare program. They have private contracts with Medicare. So these plans, they often will not have much of a premium. They might have no premium that you pay ongoing monthly payments for. And then they also might have a yearly limit on how much you actually pay out of pocket. And they can have add-ons such as dental or vision, things like that. So there are a lot of pros there for Medicare Advantage, especially if you're a more healthy person. You might not, if you don't have a lot of doctor's visits, hospital visits, or expensive drugs that you have to buy, then it might just be okay to have this, and you'll not pay much of a premium. It'll be not very costly at all. A con of this is most plans do require you to go to their network of doctors, and they also require you a referral from a primary care physician in order to see a specialist. So it's a little bit of a restriction compared to the other plan there. And then the copay and coinsurance costs, they can add up and they differ between plans. So it's a little bit less straightforward and could potentially end up being more costly.
All right, thank you so much, gentlemen. Great insights as always. And coming up after the break, Rishi and Anthony will walk us through your options for Medicare. That's next in our planning tip of the week. Stay with us.
You know it is important to check up on your health, but what about your wealth? If you aren't sure if you've saved enough for retirement, or if you don't know what your taxes will be once you do retire, or if you feel uncertain about how much risk is in your portfolio, then it's probably time for a financial checkup. I'm Rachel Meyer, and our team at Wheelhouse Advisory Group is ready to give your finances a checkup to help you live the retirement of your dreams.
This is the Wheelhouse Retirement Show.
Hi, I'm Rishi Ghosh, and we're back with the planning tip of the week. Oftentimes viewers will come into our office and ask why their Medicare premium has gone up from the prior year. For Medicare beneficiaries who earn over $91,000 a year and who are enrolled in Medicare Part B and Medicare Part D, it's important to understand the income-related monthly adjustment amounts, or IRMAA, which is a surcharge added to the Part B and Part D premiums. Since 2007, high-income Medicare enrollees have been required to pay IRMAA surcharge for Part B coverage, and IRMAA surcharge for Part D premiums took effect in 2011. IRMAA is determined by income from your tax return 2 years prior. This means that your 2022 Medicare premiums, your 2020 income tax return is used. This amount is recalculated annually. You will receive notice from the Social Security Administration to inform you if you are being assessed an extra charge through IRMAA. The income used to determine IRMAA is a form of modified adjusted gross income, but it's specific to Medicare. The modified adjusted gross income is different from your adjusted gross income because some people have additional income sources that they have to be added to their AGI in order to determine their specific IRMAA income amount. It's important to understand that MAGI for calculating IRMAA isn't the same as normal MAGI that you might be accustomed to for non-healthcare purposes, nor is it exactly the same for MAGI for calculating premium tax credits and Medicaid eligibility under the Affordable Health Care Act. Table 1 in this Congressional Research Survey brief is useful in seeing how MAGI is determined for IRMAA calculations. For 2020 income, if an individual made $91,000 or more, or a jointly filing household made $182,000 or more, then the IRMAA assessment increases the 2022 Medicare Part B premium to the amount that shows in Table 1. This level has risen from 2019 when the income requirements were $85,000 and $170,000 respectively. 2020 was the first year that these MAGI income levels were adjusted for inflation. Going forward, the IRMAA income level will continue to be adjusted for inflation. For Part D, the IRMAA amounts are added to the regular premium for the enrollee's plans. If you are on Medicare Advantage policy member, and that plan includes prescription drug benefits, then both Part B and Part D IRMAAs are added to the plan premium. Remember, Medicare Advantage enrollees always pay for Part B premium in addition to any premium charged by their Advantage plan. The following income levels trigger the associated IRMAA surcharges in 2022 for Part D. You can appeal the IRMAA determination if you believe that your calculation is in error. In addition, if you have had a life-changing event such as the loss of income or a divorce, then you can refile or you can file for a redetermination using Form SSA-44. Further complications have been introduced as a result of the newly enacted Secure Act, which was enacted in late 2019. The Secure Act has a number of different features, such as allowing IRA contributions after age 70.5 if you are still earning income. And it extends the minimum age that one must receive a required minimum distribution from 70.5 to 72 years old. The reason this may be important is that it is possible by delaying and receiving your RMDs, this may also reduce your IRMAA if your modified adjusted gross income is close to the limits stated in Tables 1 and 2. The reason that this is important is people withdraw from qualified funds such as 401ks, IRAs, and 403bs, and these funds are taxable once transferred to your individual checking, savings, or brokerage account. The amount distributed is added to your taxable income, so exercise caution when receiving distributions from qualified funds. This additional income will increase your modified adjusted gross income and may subject you to higher Medicare Part B and Part D premiums. Further, non-qualified funds must also be tracked because of the way that mutual fund capital gains and dividend distributions are made. At the end of every year, many mutual funds distribute capital gains or dividends to those with mutual fund holdings. As a result, people can unknowingly earn more income through these investments, and this can cause higher Medicare premiums. The inverse is also true for capital losses, which can reduce your MAGI and potentially reduce your Medicare Part B and Part D premiums. Here at Wheelhouse, we believe in taking a proactive approach when it comes to tax planning. This is often done through Roth conversions, which increase income. Completing tax planning and maximizing certain tax brackets may result in higher Medicare premiums if not done correctly. We recommend that you speak with a tax planner or financial advisor if you have questions about your specific circumstances, including investment income or your plans to withdraw money from your retirement accounts, including withdrawals for tax planning strategies. Understanding how this works, including what counts as income as far as Medicare is concerned, is a key part of financial planning. And since the government will base your premiums on your income from 2 years ago, You'll also want to have a good understanding of how to appeal an IRMAA determination in case you experience a life-changing event that reduces or increases your income. Planning for IRMAA and Medicare is just one of the additional facets of retirement planning that Wheelhouse team can help retirees with. That's the planning tip of the week. I'm Rishi Ghosh, and we'll be right back.
What does your retirement look like? Is it filled with travel, time with your grandchildren, uninterrupted rounds at the golf course? Or are you too worried about your financial future to even think about your hopes and dreams? Questions about retirement are normal, and the team at Wheelhouse Advisory Group can answer your questions with a complimentary review of your retirement plan. Wheelhouse Advisory Group specializes in helping people just like you prepare for the retirement you dream of. Rishi and Anthony will review your current strategy to expose the potential hidden weaknesses that may exist in your retirement portfolio. Plus, they will explain potential risks and possible strategies to you in clear and simple language. Retirement doesn't need to be scary. Let Wheelhouse Advisory Group help you retire confidently, because every dream needs a plan. Call Wheelhouse Advisory Group now to schedule a visit.
Welcome back to the Wheelhouse Retirement Show with Rishi Ghosh and Anthony Stryker. We've covered healthcare planning for investors who retire before 65 and Medicare planning. But what about long-term care planning? This is such an important topic, one that a lot of people, they want to have long-term care, but they don't want to pay for it.
Right. Long-term care planning is actually a very pivotal part of our overall process. It's actually one of our 5 speed bumps. Speed bump number 5, that we believe that if you at least don't think about or plan for it, you may potentially have a disruption in your retirement. So I wanted to start out today really with one of the, let's call it a myth when it comes to long-term care planning that I hear a lot that when people come into our office, which is Medicare or Medicaid will cover my long-term care bill if I need one. And realistically, if you look at Medicare, if qualified, Medicare may only cover a portion of skilled nursing home care costs up to 100 days. Medicaid is only available to those with limited assets and income, so realistically not really a Wheelhouse retirement client there. And if Medicare is only going to cover skilled nursing up to potentially 100 days, we wanted to say, well, what's the average stay? Well, the average stay in a nursing home is actually 835 days. So if Medicare covers potentially 100 days of that, what is going to happen for the other 735 days? So that's where we want to focus on with our clients is how exactly can you either A, build it into your plan how to afford a long-term care policy, or if you're going to self-insure, making sure mathematically you can do that properly.
Okay, if we are footing the bill ourselves, what are some of the costs that we're looking at here?
These costs are really dependent on what your situation is and what the type of long-term care that you might be seeking or might be best for your situation. So we've got some national averages here from 2020, and we've got about $20,000 per year for just a simple adult daycare, and then we've got assisted living at a little over $51,000, and then up to having a private room in a nursing home is $105,000. That's a national average. So, you know, in higher expense parts of the country, your Californias and your Floridas, that might be up near $140,000, $150,000 per year. So when we talk about this practically, they're 835 days spending maybe over $100,000 for 2.3 years. That can really take a really big chunk out of someone's portfolio if they are planning on self-insuring. We've had clients who at retirement communities in St. Charles or Fairview Heights might be $7,000 or $8,000 per month, but if they have memory care issues or something like that, they might have to have around-the-clock care for a while, and those bills end up being $12,000 or $13,000.
Yeah, they can get astronomical. And these are higher costs that we talk about during retirement, and it all starts with a plan. How do you help your clients prepare for these higher costs?
We really try to make sure that as much as possible through conservative planning that the money is there in retirement to potentially self-insure for this big risk, this big speed bump. So one of the things that we do in our first couple of meetings with a prospective client family is we take the assets, the assets that they have, the income that they have, the expenses that they have, and we draw it out in our calculator called the retirement analyzer. And the way we check for this risk is we say, what is the average age that somebody goes into a long-term care facility or has to have somebody help them at home? And that's usually late 70s, early 80s, depending on age, depending on gender, depending on a lot a lot of different factors there. And so what a lot of people's eyes are drawn to is that far right part of our retirement analyzer, which says at that age, at age 81 in 2046, how much will I have in spendable assets? For this type of portfolio and this specific family or hypothetical family we have up on the screen now, they're sitting on about $1.4 million in spendable assets. That's IRAs, 401ks, Roth IRAs, spendable retirement assets. They might be able to self-insure for this type of risk. On top of that, their protected assets might be something like homes that they could sell if need be for this type. So if we looked at a retirement analyzer and saw this type of outcome, we'd say, okay, maybe this family can self-insure based on the costs and based on their situation.
Okay. Final thoughts that you'd like to send out to our viewers about this very important topic?
You know, long-term care and major medical is very scary, especially if you have a family member, aunt, uncle, mom, dad that have gone through it. But my father always taught me, and I teach our clients all the time, day in and day out, we don't pay for somebody to do something we can do ourselves. Whether that's an investment plan, tax plan, or estate plan, we don't pay somebody for something we can do ourselves. So, you know, as fiduciary financial planners here at the firm, we do believe that if you have the opportunity to self-insure yourself, you should take advantage of that, but you have to make sure you have a mathematical plan to get there. 97% of advisors agree that families need to discuss long-term care before they need it. Unfortunately, many advisors don't want to talk about it when you come into their office. They only want to talk about buy this stock, sell this stock, buy this annuity, sell this annuity. But as total retirement planners, it's a pivotal part of total retirement planning. More than half of Americans, this is kind of a baffling statistic, more than half of Americans believe their spouse is not going to need long-term care, or they'll have the conversation when they need that part of or when they talk about that together. And then 72% of individuals worry that they wouldn't be able to provide adequate care for their loved ones if they needed it. So just those 3 bullet points there show you that it's such a pivotal part of total holistic retirement planning. And bolded at the bottom is it all comes down to planning. We believe here if you plan, overplan, the worst case situation is you have a very, very strong plan for your family. And as we always like to say, avoid the word oops in a plan. Oops, I lost $500,000. Oops, taxes went up 5%, or oops, somebody went into long-term care. Avoid the oops, and you'll have a very successful retirement.
Yeah, it's important to have those conversations, no matter how tough they can be. Thanks so much, gentlemen. Always great insights. Don't delay. Reach out by phone or on the web to get started planning for your ideal retirement future. For Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group, I'm Amy Sharp. Have a great week, everyone. We'll see you next time.